But for me, I'm comfortable right now going with an adjustable rate mortgage, letting that rate float because I don't think it's going to go up very much. And then in a couple of years, when rates come down, refinance into a lower fixed rate. So for me, I don't see a lot of risk with adjustable rate mortgages. I may have felt differently a few months ago when we didn't know where the ceiling was, but at this point, I think we've kind of hit that ceiling, and that doesn't bother me in the residential space.
Welcome to the Bar Down Investing Show. Here are your hosts, Kyle Wilson and Jay Scott.
Hey there, and welcome to another episode of the Bar Down Investing Show. I am your host, Kyle, also known by many as Ashley Wilson's husband, and I'm here with the man himself, Mr. Jay Scott. How's it going, Jay?
I am doing well. You never give your last name. You're just Kyle.
Well, I guess people just assume that Ashley Wilson's husband, that my last name is Wilson. I mean, they could, if you've ever met Ashley, they could assume that I took her last name, but no, she ended up taking mine. So we got any
there, Mr. Wilson?
this week? What do we got for wins? You got any wins for us here?
Well, I think the last couple of weeks we've been using wins to talk about investments that we've made. So let's see, what investments have I made this week?
You got another one?
I do.
Every week. Jeez.
I do. I like spending money, but I like spending it on things like investments. So this week I invested in, Justin Silverio, right?
I do, because I know where you're going with this.
Yeah. So for those who don't know Justin's pretty well known in the industry. He owns a company called Open Letter Marketing, and he just launched a new company and a new product that's really cool. It's basically a software product that helps with lead generation and managing sales and acquisition pipelines and all that sort of fun stuff. It's called Invelo. And I am now an investor in Invelo, his company. And that's so funny. I did not realize that was the hat you're wearing. So
I saw you put in the show notes that you wanted to talk about Invelo, so I ran up and I grabbed the Invelo hat. We invested in it as well, and Justin was nice enough to give us a nice little swag package, care package, and one of them was a hat. So I'm wearing the hat for those of you just listening.
That's funny. So that is my investment of the week. So go check out Invelo, invelo.com, especially if you're in the single family space and looking to scale your business.
Perfect. Okay, so let's move on to scorecard. I have a huge announcement. We got our first review, and it was 5 stars.
Nice.
And it was from a user named Black Op for Hire. So I don't know what that means. A little bit scary, but it's a 5-star review, so I will take it.
I want to do something. What do you think? Should we give him a gift for being our first reviewer?
I mean, you can. I'm not giving him anything. I'm not buying reviews.
I'm not buying reviews. This is not a review buying because he's already left the review. This is a thank you. So if Black Op for Hire is listening to this, go out and find my email.
He was listening so much that he just texted you immediately as you said that.
That was actually my B-reel, which means I'm supposed to be taking a picture right now to share with my friends. For anybody that's not on the social media app B-reel. So Black Op for Hire. So if you're out there listening to this right now, shoot me an email, send me a message. You can figure out how to get in touch with me. I have a gift or something. I'm going to get you something just to say thank you. And everybody else out there that didn't get a gift, well, maybe if you leave us a review, who knows? Who knows what might happen next week?
See, now you're soliciting.
Now I'm
gifts for reviews. But I guess you're not allowed to do it for 5-star reviews, right? You're just saying for any reviews.
Leave it to any reviews, but 5s are.
And we got to say that it's random who we choose, right?
Yeah, of course.
Not just the 5-star ones.
Of course.
Okay. Next, the most important part of the show. I know the only reason I can get you to do this every week is the Rock updates. You want to know what's going on with the Rock. And I hit up a couple weeks ago, I talked about Black Adam, and there was some sad news that last week that Black Adam, as of now, Black Adam 2 is no longer happening. so after I was done crying, I looked up what happened, and basically, for those of you who don't know, DC's having a lot of issues. DC Comics is who owns Black Adam, and they also do Superman, Batman, and they've just been going through one the last few years trying to figure out what they're doing. And after a few scandals, they had this guy not Josh Whedon. He was the one who got fired. James Gunn take over and take over as the helm, and he just has a completely new idea of what's going on. And so The Rock and actually Henry Cavill are stuck in this in the crossfire because he's taken over and he's taken a new direction. So we might see a one and done with Black Adam. He left it open, but that might be the end of it. So sad news.
Yeah, that was more information than I ever needed about Black Adam. But thank you for sharing that Rock update. For everybody
don't lie. You loved it. Okay, so headlines. We got some. It wasn't as big of a week as last week, but we still have some interesting headlines. So first, we have share of homes bought with all cash hit the highest level since 2014. That was an interesting one. Got any insight on that?
So I don't have any insight on that. Actually, I didn't even realize that. I didn't look at the headline notes, so I'm being surprised here with everybody else. So share of new homes, I assume that's single family homes, new all cash, new high since 2014. I'm guessing that's just people having difficulty getting mortgages, or maybe I don't know if.
Yeah, it's interesting because you can look at that from both ways, right? So as interest rates get high enough, then people look to other ways in order to buy the houses. So you can look at it that way. But also historically, a big portion of houses bought in all cash would be investors, right? And all of our headlines would say that investors have been pulling back. So that's an interesting headline. But moving on, we also have a headline saying buyers embrace adjustable rate mortgages as mortgage rates increase. That's a kind of a baiting headline of, I don't know if it was written by a bankers, but there's actually a lot to talk about on that.
Yeah, and I think if we're going to talk about adjustable rate mortgages, I don't know if you were bringing that up from the residential side or the
It's a
commercial
residential
side.
Headline, yeah.
Okay, because I think that's actually an interesting topic, both on the residential side, so people buying their own homes, and also on the commercial side. I know a lot of us who buy apartments, for example, apartment complexes, we're facing the big question today: should we be going after these adjustable rate mortgages, which have some advantages and some disadvantages compared to the fixed rate 10-year mortgages that we typically get from Fannie Mae or Freddie Mac? Let's move this to the issues list, because I want to talk about this.
Yeah, let's put that as a front runner for issues list. Okay, next we got home sales continue to slide in November, extending a record retreat. I don't think there's anything crazy in that, but it's kind of just confirming our suspicions that things are slowing down.
Yeah, I saw that headline last week. I think we were down 7.7 maybe percent home sales, which, I don't know, not surprising. I think with mortgage rates where they are and with the uncertainty in the economy, people are slowing down. The interesting thing, though, that I remember from that data was that if you look at the year-over-year price increase, so this November from last November, we're still up 3.5% in values. So yeah, it sounds like home sales are starting to decrease, or not starting. I think it was like 9 or 10 months in a row that we've seen a decline in home sales, but we're still seeing values go up year over year, which means that something's propping up the market. What do you think that is?
Yeah, I don't know. That's to me, that's just got to be your standard supply and demand thing. Right now, we're in such a weird time with supply and demand. You saw that when COVID first hit, you would expect that the prices were going to go down, but just the supply was so small compared to the demand from buyers that it just propped everything up, even though the metrics pointed a different way. So that imbalance just has to level itself out for us to see a little bit more normal housing market.
Yeah, I predicted back in, I guess, when rates started going up last March, April, basically my prediction was we were just going to see a year of stagnation, basically no transaction volume, sellers that didn't want to come down in price, buyers that didn't want to come up in price. And we've sort of seen that in the commercial space. I think we're starting to see that in the residential space as well, that things are just kind of, they're steady state. Things aren't going up, things aren't going down, but the number of actual transactions is dropping considerably.
Right. And if you had locked in a 3% mortgage rate, why would you even consider selling and moving somewhere and having to pay 6, 7? So not surprising. One of the more interesting headlines that I saw is that Blackstone is limiting their withdrawals from the real estate fund to avoid a liquidity mismatch. So Blackstone is, one of the cornerstones of the real estate market as far as a fund is concerned. I think they have one of the largest funds in the world for real estate assets.
70 billion.
Yeah. So to see them for the first time, it looks like they are having requests for liquidation or people to get their money back. For the first time, that is outstripping what they have in actual liquidity to pay out. So people are obviously getting a little bit nervous about what the real estate market's going to look like investing wise for the next year or so.
Yeah, and for those who don't quite get what that means, basically, Blackstone has this big fund. They have this $70 billion fund. People put money in the fund, and the fund doesn't just stop at some point. The fund keeps going for a long time. And if people want their money out, basically what they do is they request a redemption. They say, I want my money out, give me my money back. And I think there's something like 1% or 1.5% of the total fund value that they allocate to give money back every month, or every quarter, something like that. And this past month or past quarter, the number of people or the amount that people have been asking for back has been more than 2% of the total fund value. So basically, for the first time, Blackstone has had to say, hey, we can't give you your money back right now because we're over our limit of giving money back. And I don't know if they don't have the money or they just don't want to give it back. But for the first time, they're basically saying we're not giving it back, which means there are investors out there who are probably not going to be too happy with them. And that could hurt their ability to raise money in the future.
Yeah, maybe they're all taking their money out to put in pref equity.
Yeah. Throw it into our fund.
So do we want to stick with the adjustable rate mortgage for the issues?
Yeah, I think we want to talk about that because, again, I think we can talk about that from the residential side. We can talk about that from the commercial side. And there's a lot to unpack there. So, yeah, let's.
Yeah, that's great. So, because you touched on that, it is kind of two different conversations, right? The residential versus the commercial. And the reason is that the United States is one of the only countries that offers a 30-year fixed rate mortgage product. And not only that, with no prepayment penalty. So you can get a 30-year fixed rate mortgage. And after 2 years, if you want to sell it and move into a new house, they don't care. They'll just be like, okay, enjoy your new house. You have to get a new mortgage, but you don't have to prepay this big prepayment penalty that you see in commercial mortgages. So I think it's two different conversations. Let's start with the residential. What do you think people should be doing? We talked about mortgage rates peaking, that we believe they've peaked. So the belief is that they're going to start to come down. So is it smart to get a fixed rate right now, or should we be looking at adjustable rates?
Well, I think the big question that we need to be asking ourselves, well, two questions. Number one, how long do we think mortgage rates are going to be where they are now? Right now, we're just over 6%, which obviously is a good bit higher than we were 6 or 12 months ago. And number two, how far do we think they're going to fall? I mean, if mortgage rates steady out at 5% a year from now and stay there for a while, there's not going to be a lot of advantage to holding off or getting an adjustable rate mortgage or refinancing. I mean, we're probably just going to want to lock something in for the long term. But if we think mortgage rates are going to drop back down to the 3% or even 2.5% that we saw a year ago, then it may be worth it to pay that extra cost to do a refinance. So for me, I mean, I'm not too concerned about rates going much higher. So I'm not scared of an adjustable rate loan right now. That's the risk, obviously, of the adjustable rate loan. That 2-3 years down the road, when you have this loan that you've locked in and it's a floating rate, rates go up 2 or 3%, and now suddenly your mortgage is higher. You can't refinance into a fixed rate loan, but I don't see that happening. But for me, I'm comfortable right now going with an adjustable rate mortgage, letting that rate float because I don't think it's going to go up very much. And then in a couple of years, when rates come down, refinance into a lower fixed rate. So for me, I don't see a lot of risk with adjustable rate mortgages. I may have felt differently a few months ago when we didn't know where the ceiling was, but at this point, I think we've kind of hit that ceiling, and that doesn't bother me in the residential space. How about you?
It's a tricky thing emotionally, right? As far as the standard like we're in real estate every day, so we are comfortable with changing expenses, just changing real estate landscapes. But there's something just comforting about knowing what your mortgage payment is every month. And I think that has to do part of why the fixed rate mortgage is such the overwhelming favorite in the residential mortgage space, because and it's also with your ability, to your point, to refi at any time. Like I heard, I think it was Robert Helms or one of the real estate guys say it the other day, where there's three things can happen, right? Either mortgage rates go up, mortgage rates go down, or they stay the same. And in all three scenarios, when you're looking at the housing market right now, what's keeping housing prices from going up is these high mortgage rates. If mortgage rates went down, then theoretically the housing prices would go up. So if you lock in a fixed rate right now, in all three of those scenarios, you're going to be happy. If the mortgage rates go up, you're going to be happy you locked in at a lower rate. If mortgage rates go down, you're going to be happy because theoretically the price of your house should be going up because the rates are going down. And if it stays the same, then it stays the same. So I don't think you can go wrong right now with either one. I'm not going to get mad at you for fixing a rate, even if you think that mortgage rates are going down. But I do think it's a little bit trickier when you get into commercial loans, because you don't have that option of no prepayment penalty. If you fix a loan rate with a commercial loan and you want to, for 10 years, if you want to exit after year 3, you could be talking about millions and millions of dollars of prepayment penalties.
Yeah, I think there are a lot of people out there that probably aren't familiar with kind of the intricacies of the two major types of loans when we talk about large commercial loans. Do we want to start with that? Why don't you give an overview of like the two big types of loans and the benefits and the drawbacks of each?
Yeah, so there's two big types. It's the same fixed versus adjustable rate, and they like to say in commercial terms floater. So it's a floating rate. And so basically the fixed rate's the same, where it's just fixed for a set amount of time. You can get 5-year, 7-year, 10-year, 12-year. There are some 30-year products. They're just not standard. Or versus a floater rate, it's the same as an adjustable rate for residential, where you pick some indice. Typically right now it's going to be SOFR. And you take a spread above it. And so whatever that spread is, whatever the SOFR rate is, you take 200 bips or 300 bips or 3% above that standard rate. So if SOFR is around 4%, then you're going to be looking at 7% for your rate at that time. So it's the same in that sense, but there are other different products. So you have your standard products from your, what they call agency lenders, which is Fannie Mae, Freddie Mac, who also do residential, but they do commercial as well. And we're talking about, I'm going to generalize for apartments, but this can kind of go for many other commercial products. Fannie Mae and Freddie Mac, they'll offer fixed and floater options. Their fixed rate, you fix it for as little as 5 years and up to 12 years. But if you decide to exit, then you have to prepay basically what the bank or what the Freddie or Fannie is losing by you prepaying that loan. So if you think about it, the fact that they are reselling these mortgages, if you're reselling a mortgage and that investor is expecting to get 5% because that's what they paid for, and that term ends, then that payment has to be replaced with something else. And so if the rates are lower at that time when that payment has to go and be replaced, well, then that investor has to be made whole. So by exiting that mortgage, you actually have to prepay what that investor would be losing, if that makes sense.
Yeah, and I think that's the thing that makes commercial mortgages a lot more tricky, which is in a lot of cases we're buying these properties that we intend to hold for 3 or 5 years. But if you get a 10-year fixed rate loan and you exit in year 3, 4, or 5, your prepayment penalty can literally be in the millions of dollars. And so that's where I think a lot of people get confused. For the most part, it's easy to think, oh, if I can lock in a rate for 10 years when rates are low, why would I ever get an adjustable rate mortgage? Why were people getting adjustable rate mortgages 2 and 3 years ago when rates were like 3%, 4%, which is the greatest rates we've seen for commercial mortgages in history? Why were people 2 and 3 years ago getting adjustable rate mortgages and putting themselves in the situation they're in now where those rates are really going through the roof and they're getting hit hard? The reason is because they were only expecting to hold those properties for a couple of years, and they knew that if they had gotten a fixed rate mortgage, even at that really low rate, that prepayment penalty when they sold was going to be huge. And that's why these days when you hear about people that got adjustable rate or floater mortgages a few years ago, instead of thinking, wow, they were crazy, why did they do that? There was a good reason for them doing that. But then that math gets a lot more complicated today, thinking about if I were to buy a property today, do I get a floater or do I get a fixed rate? And again, for the same reasons. One, we don't know where rates are going to be over the next couple of years. But two, we always have that risk of if we sell, we could, and we have a fixed rate mortgage, we could end up paying millions of dollars in prepayment.
It's a liquidity premium, right? So if you want to be able to exit whenever you want, then you have to put up with an adjustable rate. And if you had done that in 2020, 2019, and you were lucky enough to be able to sell at the end of last year, then you were sure happy that you had that adjustable rate, and you maybe had a 1% exit instead of 10% of your loan. It's that premium that you pay to be able to exit at any time. And just as that example, if you bought at the beginning of 2020 or 2019 and you had a 5-year business plan, well, you would have been smart still to sell at the top of the market in 2021 and not pay that prepayment penalty. So to me, yes, it comes down to, okay, what is your business plan? If you are doing a heavy value add, if you expect the value of your property to go up rapidly over less than 3 years, then I believe it still makes sense to get that adjustable rate. But if you're holding longer, 5, maybe even 10 years is your business plan, the question is it worth it?
Yeah, and as you alluded to, there are different types of prepayment penalties, but one of those is what's known as a yield maintenance penalty, where, like you said, the lender has to replace your loan with some other loan, and if the interest rate on the loan they replace it with is lower, then they're losing money, and so you're going to pay a much bigger prepayment penalty. And I think what we're likely to see over the next couple of years is obviously interest rates are likely to go down over the next few years. And so these prepayment penalties are going to be higher than they were a year ago or 2 or 3 years ago when interest rates were going up and lenders were happy if you got out. If you got out of a 3% loan and they had to replace it with a 6 or 7% loan, lenders are happy. They're making more money.
Well, just a real world example. We purchased a property a year ago, and at the time interest rates were sub 3%. And the interest rate payment on this loan was 3.89, I believe.
Yep.
So it was about a 1% difference, and the loan was in the high 20s, 28 million or something like that, and the prepayment penalty on that loan would have been $6 million. So purchase price close to $46 million difference on a prepayment loan. That's massive. And that's just in a 1% difference. And now you're looking, what's the spread now? We were at 3% loan rates before, and now we're up to 6%. So that's a 3% change. So just imagine what the prepayment penalties on similar loans would be now.
Yeah, and so this is where the math for these loans gets really complicated, and this is why even for the best commercial investors, we need to basically make some wild guesses about where we think the market's headed over the next few years, where we think rates are headed over the next few years. But just as importantly, we need to know our business plan, and we need to know, are we planning to hold this property for 2 years or 4 years or 8 years? Because at the end of the day, the amount of time that you end up holding the property could be the single thing that drives that decision more than anything else. And it can be difficult. For several years back in 2018 to 2000, this year, 22, we were seeing deals that we were planning to hold for 3 or 4 or 5 or 6 years, but the market was going up and up and up. And so we'd get a year or year and a half or 2 years in, and we'd be like, okay, let's sell it. And we were willing to eat that big prepayment penalty by selling really early. Well, moving forward, it may be a lot more difficult, number one, to sell that quickly. But number two, it's going to be a lot more difficult to eat that prepayment penalty because we're not likely to see that same rise in the market and value increase that we were seeing over the last few years. So yeah, it's complicated math, and it requires some guesses. And so this is one of those things. If you're a passive investor and you're investing with people that are buying these assets, always good to find out what their assumptions are and how they're deciding what type of loan to go with, because it's interesting math. And if you disagree with their assumptions, it can really impact the end result of the investment.
Yeah, and it sucks to say it depends, but it really just depends, because there's so many other factors. When you talk about floating rates, there's this other outside factor that no one really paid attention to up until this year with the interest rate cap. You have to every single time you get a loan, the bank wants to protect itself, so it basically makes you go out and solicit an outside insurance company to buy an interest rate cap, so that if interest rates go up by 2-3%, that the bank is still covered in the fact that the debt service coverage ratio will still be at a level that they're acceptable, and they still believe you're going to be able to make your loan payments. Well,
and that's just for floaters. So
right. Exactly. That's just for floating rates, because they want to make sure that you're going to be able to pay the mortgage if the rates go up a significant amount. Well, interest rate caps were reasonable amounts before, 1%, less than 1%. Now we're seeing, with the volatility in the market, these interest rate caps have skyrocketed, and we're seeing, $14 million loans need a 1-year interest rate cap of $500,000 for 1 year. So that's going to hit your bottom line and your returns as well. Also with the floating rates, if you're going with something like a bridge loan product for a floating rate, that means your all-in rate, it might be a couple percentage higher. That's what you pay for the flexibility and the higher LTVs. But the problem with that is you're going to have no cash flow. Your year one, while you're doing that value add, you're going to have no cash flow. So you're having to trade off cash flow now for the ability to exit and refi or sell a property. So it really just depends. It comes down to your business plan as well. To Jay's point with, how long do you plan on holding it? And I follow this guy, JP Conklin from Pensford, and he throws out a lot of great stats. His podcast is called the Rate Guide Podcast. And so he talks about interest rates and in this kind of stuff. And he kind of actually went through, this was a while back, about different time periods. And he found that in a 2-year time period, that 23% of the time it was better to fix the rate. But the big difference is, though, if you were wrong by fixing the rate, the maximum savings by floating was 3.38% annually, versus if you're wrong by floating the rate, the maximum was 1.2. So you actually get more if you're wrong. It's better to have floated than fixed, because you lose a lot more by being fixed. So that gets back to the emotional thing, though, too. Like, yes, historically, if you look at stats, maybe you're floating, but fixed rate, just knowing what your monthly mortgage payment is these days, right now, knowing what your cash flow is, there's something to that.
I'm gonna end this conversation with just an example. We own two properties, and like you said, one of them is fixed rate at it's actually 3.96%. I think you said 3.8 something, but it's somewhere in the 3.8 3.9%, fixed for like the next 9 years. And the other property, we're fixed at under 3%, like 2.96% for like the next 8 years or something. And I don't know about you, Kyle, but I don't lose sleep over those properties ever.
As opposed to our other one that we have an interest rate cap coming up in the next summer, and we basically scheduled out a meeting already to, okay, in May we're going to decide what we're doing with this.
Yeah, and that's the property that it's going great. I'm not overly concerned, but let me tell you something. If I have to think about any of my three properties, that's the one I'm thinking about, simply because we have the floating rate. And so, yeah, there are some advantages to maybe getting a floating rate in some situations, but there's also advantages to being able to sleep well at night, knowing that your rate's never going to change and that you're never going to have to run into a situation where the economy goes haywire like it did over the last 6 months, and then have to make some really hard decisions. So there's the financial decisions that we always have to make. But at the end of the day, part of investing is sleeping well at night is also. So sometimes you forego the perfect optimal financial decision, and you make that decision that's going to let you sleep well at night, because you're not going to be in a difficult situation if something changes down the road.
So what all people care about, though, is if you're buying a property right now, which one are you leaning towards?
Today, if I'm buying a property, a typical value add property that I plan to sell in 3 to 5 years, I'm probably going with a floating rate. If I'm buying something that I'm planning to hold longer term, I'm probably going with a fixed rate. But you know this better than I do. What do you think?
See, I'm almost of the opinion I'm going floater either way, just because if we were at a lower interest rate environment. Now that we've seen how low we can go, it's a different conversation if we're at the 4%, sub 4% rates. That if interest rates go up, there's always the option that someone can assume that loan. If I'm getting a fixed rate right now, I have to just bake into my model that if I want to sell at the halfway mark, then I'm having to pay that prepayment penalty. Maybe you can adjust, the banks let you sometimes negotiate what the prepayment penalties are up front. They, have step down basis instead of just true yield maintenance, where you could say, okay, at year 5, it's 5%, at year 6, it's 4%, year 7, they can, so it's standard. So you can kind of bake that into your model. So there's things you can do like that. But just after last year, seeing how crazy things went, where you'd see the market go up 5% in a month in the prices, I think just that flexibility of now I want to be able to recognize when that happens, and I want to be able to just sell. And I know it's going to be a bit of a hit on cash flow potentially in the beginning. But if this is a true value add and we can make up that cash flow, I think I'm just exploring the different floater rates from now on until we see lower fixed rates.
Yeah, I think we both agree that in most cases, we're probably looking at the floater simply because we've probably hit a peak. Things are probably going to trend in the right direction, in the good direction for us over the next couple of years. And the other, we don't have to delve deep into this, but the other advantage to floating rate products these days is typically you can get a higher LTV or LTC than you can over those fixed rate products. So you can bring in more debt, and you have to raise less money from investors to cover that down payment. So another advantage there as well.
Perfect. Great. You got anything on the to-do list coming up?
So it is Thursday, December 22nd, which means we are 3 days from Christmas, which means I get to start my Christmas shopping any day now. I could start today, but it's a little bit early still.
I think you might have missed the Amazon 2-day window. That was last night.
I do that every year. But yeah, so I'll start thinking about Christmas shopping in the next couple days, and the wife's birthday is on Christmas Day, so I guess I'll have to think about that as well. And we're starting to work on our travel schedule for next year. So for anybody that wants to get together with the team and do some networking, we've been talking about doing a bunch of live networking events around the country in 2023. Get out there, meet our investors, and meet other people. So stay tuned for us to release our live travel schedule for 2023.
Awesome. Well, wrapping that up, how'd you think it go? Another great rated show.
Once again, if we go less than an 8, I have to talk more. I don't want to do that, so I'm going with an 8.
I'll give it an 8.1. I think it was a little bit better than an 8, but I still think we got a lot of work too. How do you want to sign this one off?
I think we've done great with the quotes the last couple weeks, so I have to imagine you've come prepared with a quote. I don't think I'm gonna throw you off by asking for a quote. So
I had to literally go out and be like, okay, I need a quote for every week. So that's that's my homework for the week. So I had a good one from Mark Twain, just because I listened to I listened to a lot of business podcasts, and things are so crazy with the stock market, and people were looking for that Santa Claus run up, and it didn't happen. And so Mark Twain had a quote where he said that December, this one is particularly dangerous month to invest in stocks. Other dangerous months are January, February, March, April, May, June, July, August, September, October, and November. So just to show you that stocks are a dangerous place to be. So let's just put all our money in real estate, right?
That's what we're doing.
All right. Well, we appreciate you suffering through this week with us again. I think coming up, we might have another drunk real estate to relieve your pain from all this serious talk. So stay tuned to that. And until then, thanks for coming out.
Thanks, everybody.